Joining us this morning, Charles Schwab, Chief Investment Strategist Liz Ann Saunders, and here at Post 9, JP Morgan's Asset Management Portfolio Manager Phil Camporeale. Guys, good morning. Great to see you both. Liz Ann, I'd love to get you on the Fed lately, especially in the wake of Daily, talking more about two-sided risks. Even Larry Summers says maybe we don't get to 5 on the terminal rate. What's your view right now on what we're hearing?
So I do think you are watching this shift by the Fed via the many speakers from really having their focus purely on the rearview mirror in terms of inflation as the data has come in. And I think a bit of a descent in traditional measures of inflation have given them some leeway to start to, drive using the windshield, understanding the variable lags in terms of monetary policy. So I think that's the right step. We are slightly biased to the terminal rate being maybe a little bit less severe on the upside than what is priced in, but they're still data dependent. So there's a lot of data between now and, say, the February meeting. I think it's probably 50 basis points for December, though. Interesting.
Speaking of the rest of the year, Phil, a lot of people today, it's Deutsche, for example, saying 4,300 by year end, the positioning and the buybacks, those two things together. Does that make sense to you?
Yeah, I think the path of least resistance in the near term, Carl, is probably higher. And it was funny to hear the Fed's policy is beginning to do its work. It's led to the worst fixed income year in the history of bonds, right? So I think from the standpoint of, okay, where do we end up? If we're at 4% on the target right now and we're getting to 5, they're 80% done. If they go 50 in December, that's 4.5. If they're getting to 5, that's 90% done. Carl, that's a huge, huge weight off the shoulders of investors that have had absolutely nowhere to hide this year. But I don't really think the open mouth operations from the Fed changes anytime soon, which allows the market to really run. And I actually think the better place to be next year is probably in fixed income than in equities.
Liz Ann, there's a way of, I guess, telling the story of 2022 as if this was a big payback reset year, and maybe a lot of things were packed into it, right? We did get the Fed going from 0 up toward 5% perhaps by the end of the year. You've had the S&P 500 valuation come down from, 23 times to 17. The speculative parts of the market have been completely blown out. There's not been an IPO of any size in a while, and you have that real retrenchment in bonds. So where does that leave us as a starting point in your view for 2023? Obviously the economy doesn't operate by the calendar, but I'm curious how we should think about it.
Well, we're all of us at Schwab are putting together our forward year outlooks. Mine will be published next week, and you are going to hear from us, particularly my colleague Kathy Jones, who I know you all know on the fixed income side, about a better outlook for fixed income. There is income in fixed income. There's a lot of strategies, particularly active strategies, you can take to take advantage of this. I think from an equity market perspective, I think if you have, say, a 1-year time horizon, I think the outlook is pretty good. Sentiment, at least recently, has been supportive of that. Some of the positive divergences you've seen in various breadth indicators. I still think the market may not have fully digested the coming weakness in the labor market, which is the Fed is still trying to engineer. So trust them that they will probably be successful in doing that. And I think there's more re-rating on the downside in terms of forward earnings estimates. But you can check more boxes of, all right, things are starting to look better at the recent lows than you could back at the mid-June lows. But I think there's still some stabilization that needs to occur in housing, in forward earnings estimates, which means the near-term outlook is probably a bit more volatility, even if the sun is shining a bit brighter with, say, a 1-year outlook.
And Phil, with regard to equities, you're still a little more cautious. Yep. What has to line up for you to get to that point of saying now the coast is a little clearer?
Yeah, so Mike, the October CPI report that we got 2 weeks ago highlights in a major way how crowded the short is. We got a 5 standard deviation move in 1 day on the market. So while that didn't really change much fundamentally because it was only one number, it does highlight how crowded the short is.